Today we have Vinay Jain. He is the head of research and portfolio manager at Karma Capital. Let's talk about early cycle investing.
Everything goes through a cycle. Economies go through a cycle. Countries go through a cycle, and that's in the same way. Sectors and companies also go through a cycle. So what we try to do via early cycle investment is try to identify that opportunity early in its inflection point.
You are also looking for growth. It's just that you're trying to find out companies which are about to grow. It's not something which in growth has already been discovered.
We have a universe of around 300 odd names, and we continuously track them over longer period of time. So the idea is not to go wider, but to go deeper into these names.
A space where the crowd is disinterested in, that is more interesting to you.
If everyone is thinking the same way, then no one is actually thinking. If say I am reading that research report which is going to hundreds and thousands of investors, and if I'm acting on that, my returns would be similar to what the market returns are. So if I have to create an alpha versus the benchmark or versus the market, I have to think differently.
Welcome to the second episode of Karma Connect. Today we have Vinay Jain. He is the head of research and portfolio manager at Karma Capital. He is currently managing our all-cap strategies, Karma Wealth Builder and Karma Capital Jasmine. Vinay began his journey in the field of management and research with Karma Capital as a research analyst way back in 2013. He has over 12 years experience in his present role. Other than managing all-cap strategies at Karma Capital, he is also heading the research vertical responsible for overseeing all our research activities, leading the research team, generating new investment ideas and carrying out qualitative and quantitative analysis for his coverage universe. Over the years, Vinay has tracked and covered various sectors like pharmaceuticals, healthcare, automotive and automotive ancillaries, capital goods, infrastructure, chemicals, media and entertainment, and in the course has managed to create his circle of competence in each of these sectors. Hi Vinay, welcome to the show. We'll start with the investment philosophy itself, and so let's talk about early cycle investing. So how you think early cycle investing is differentiated and vis-a-vis the other investing philosophy? I mean, how does it marries with GARP as a philosophy?
Thank you so much for having me, Pramod. What we feel is everything goes through a cycle. Economies go through a cycle, countries go through a cycle, and that's in the same way, sectors and companies also go through a cycle. In India, again, what we feel is once the growth is discovered, it is reflected in the price. So what we try to do via early cycle investment is try to identify that opportunity early in its inflection point. So we are not looking for companies which are already growing at say 15-20% because again, as you know, the price is already reflecting that growth in its price. So what we are trying to do is look for companies who have maybe in the last 2 to 3 years not done that well as to the true potential as they can do, and identify these companies early before the market does. So that is what I would say is a key differentiator. And people often confuse early cycle with value investing. But over here, when we say there is early cycle with a blend of GARP in it, we are not looking for mispriced opportunities. What we are trying to do is identify opportunities which can have a second order derivative of growth, which is like an acceleration or rate of change of growth over the next 2 to 3 years. So as I said, like someone which has not say maybe growing at 5% in the last 2 to 3 years, can it grow at 15 to 20% over the next 2 to 3 years? So that is, I would say, differentiates us versus, I would say, value investing. And because it is GARP, because we are trying to identify that opportunity early in its business cycle, we are able to buy it at a slightly, I would say, reasonable to lower valuation. So because again, the price is not reflecting the true potential which can come through over the next 2 to 3 years.
So if I've understood correctly, it is basically you are also looking for growth. It's just that you're trying to find out companies which are about to grow. It's not something which in growth has already been discovered. So that's wherein your hard work is actually rewarding you by continuously identifying companies which are about to grow from here. That's how it is?
So yeah, like you said it correctly, Pramod. So what happens is we have a universe of around 300 odd names, and we continuously track them over longer period of time. What that does is in the course of time, we try and build a core circle of competence around these names. So the idea is not to go wider, but to go deeper into these names. And again, like we review these names once every year. And in that also, I would say around 10 to 15 names are removed and another new names, around 10 to 15 names are added. So it's not like 100 names are getting removed and 100 fresh names are coming into the universe. So this universe again is a very steady universe, I would say, of companies having established businesses with management pedigree, potential or scope for the business to grow. So the profit pool of the industry in which they are operating is quite large. So again, it's a steady universe, but again, it could be because of say macro reason or company related issues that the company has not been able to deliver to its potential, true potential. And again, what we are looking for is key catalyst. So for each of the companies which we track, we have key catalyst which we very closely monitor on a day-to-day basis, and basis how these catalyst or monitorables deliver, our conviction on these names build up. And that is what we are ideally looking for when we say, and which is what I would say the core thesis is of early investing. Look for key catalysts which can lead to that acceleration in growth over the next 2 to 3 years.
Like you said, you quoted an example that companies which have not grown in last 2-3 years, but they are about to go. So it's basically, how do you do it? You basically go against the herd. So wherein everybody sees a challenge, that's wherein you start getting more interested in and you start digging more. That's how you do it?
So typically what happens is when the companies are not doing well or they are going through a rough phase, investors tend to lose interest in the company. And because there is no interest from the investors, the sell side coverage also tends to become a little loose. And that is where our opportunity lies. So what we try to do is at that point in time is go and meet the management on a one-to-one basis, try and understand from the company, from the management as to what went wrong in the last couple of years and what would lead to that rate of change which we are talking or which we are looking out for. And again, at times what happens is because the company is not doing well, the management is also upfront and willing to meet investors. So again, because there is loose interest from the investor community as well as the sell side coverage, we get an opportunity to dwell deeper into the company and take a call whether we want to invest into that company or not.
So if I have to say one parameter which is common across such companies in terms of quantitative numbers I'm talking about. So what you said is all philosophically, but if you say what are the parameters which is largely common across all these companies?
So again, I'll maybe talk to you about, maybe just first give you what we are looking for and then maybe give you a couple of examples also in this. What we want to look for is growth. Over the next 2 to 3 years, at least till the time we own, there should be a growth which should be coming through. So company should grow at around 15-20% minimum over the time we own. We are not fixated on the return profile of the company. So typically you would have heard fund managers talking about a minimum 15% ROE, ROC of the company, below which they don't invest into these companies. But what we have seen is because the companies have gone through a rough phase, the ROC and ROE are typically subdued. But what our endeavor is that in the due course in which we own that company, the return profile also should ideally be upwards of 20%. So I'll give you an example again. Cipla is something which we bought just before COVID, early 2020. If you look at the company's financials, 2 years, 3 years prior to us owning the company, FY17 to FY20, the company's earnings were growing at just a 5% CAGR. And again, there was a lot of capital misallocation which had happened in the company. So a lot of impairment was taken on the acquisitions which were made in the US. Because of which the return profile was also subdued at around 8 to 10%. What has happened over the last 5 years, if you see, since the time we've been owning the company's earnings have grown at around 23% CAGR. What that has done is the return profile has also improved from sub 10% to now, I would say, reaching 20%. And also because of the company was cognizant about the capital misallocation which had happened, they streamlined their capital allocation policy. And what that has done is, if you see the amount of free cash flow the company has generated over the last 5 years, When we bought the company was sitting on a net debt of around 3,500 crores. Today, the company is sitting on a net cash of 10,400 crores. So, in the span of 5 years, the company has generated almost close to 15,000 crores in terms of free cash flow. So, this is typically what we are trying to look out for. Over here, again, like if you see, people usually or the investors usually consider pharma as a defensive. But here, there is a company within pharma which has grown its earnings at around 20% plus CAGR. And we continue to be positive on that name.
So, can I say it like this, that a space where the crowd is disinterested in, that is more interesting to you?
Obviously, again, what we have seen is if everyone is thinking the same way, then no one is actually thinking, right? So you have to be different, you have to be early before the crowd actually identify that opportunity. Otherwise, again, if say I am reading that research report which is going to hundreds and thousands of investors, and if I'm acting on that, my returns would be similar to what the market returns are. So if I have to create an alpha versus the benchmark or versus the market, I have to think differently. Usually what happens, Pramod, is that people like to extrapolate things. The past, they like to extrapolate the past into the future as well. People continuously want to look at the rear view mirror and extrapolate things, that if the company has been, say, delivering 30% CAGR in terms of earnings in the last 2 to 3 years, they feel that the company will continue to do that over the next 2 to 3 years. And at the same time, it works in the other way around as well, that if the company has not been performing well in the last 2 to 3 years, it will not continue to perform well in the coming future as well. But over here, that is where I would say independent thinking and building your own conviction comes into play. So you have to do your own ground research, you have to go and meet the management on a one-to-one basis, and the conviction has to build up and has to come up from within. If you're dependent on sell side, you won't be able to build that own. Alpha can't be generated on borrowed conviction is what I would like to say.
Basically, so, borrowed conviction is not conviction at all. So, let's flip it. Say, if you want to sell a company, which you've done, so investment thesis went right, everything went right. When would you sell a company, or you would never sell a company if it is doing very well?
No, again, so again, like first, if we have gone wrong in a thesis or the company fundamentals have changed, we would be very quick in terms of cutting down that position. Typically, we don't. So it's a investment is an iterative process where you're continuously evaluating the existing company which is there in the portfolio with a company which is there in a prospective pipeline. So you continuously, we would want to hold on to an existing name as long as we feel that the growth is there and there is growth potential in the company, at least from our next 1 or 2 years. If we feel that the growth is sort of slowing down and plateauing, we will try and maybe replace it with a company in the prospect pipeline. Or else, the second thing is, if we feel that the valuation have run up quite significantly in a short span of time, then we might do certain amount of trading around that particular name. But typically what we have seen and what we have implemented is, when we are exiting also a company, we try and exit it in a staggered manner, so that we don't try and tend to miss out on the upside as such.
No, correct me if I'm wrong, Vinay. So, if you're buying companies which haven't done well in the past, what are the chances? So, there are two ways. I mean, what are the chances that prices will go down further from where you have bought? And what are the chances? I mean, of course, you buying it for the price appreciation. What if the price doesn't appreciate from the day, from the time you have bought? How do you manage that? That's also a risk, because see, Howard Marks says that in contrarian or in early cycle investing, as he says it, being too early is equal to being wrong.
Right. So again, a very good question and a very relevant one as well. What we have seen is over the years, again, our practice also has been to be as close as to the inflection point of growth which is there. We are trying to do that, but what happens is you can't time it perfectly. Okay. But what we try to do is we position or size up the position in a gradual or a staggered manner as well. So, if you want to have a target weight for a company, say 6%, at day one itself, we won't have a 6% weight in the portfolio. We'll start maybe with a small weight as low as say 1.5%. And then as a conviction or as a catalyst start playing out, we try and build up our position. And what the best part over here is that because we have entered that company early, it's an undiscovered idea. Okay, so the market has not identified that idea as yet. We get time to build up that position, so we can build it up over a 2 to 3 months sort of a time frame. And again, as this is something which we very closely monitor, which is the catalyst or the monitorables which are there, they need to play out. And again, we might go wrong in that, but we would be very quick in terms of exiting that name if we feel that we have gone wrong. And we don't tend to lose out much because again, the valuations are not that expensive.
The exact opposite to that question would be when you are exiting. How do you, what are the strategies? I mean, do you exit in one go? Do you exit slowly? If you have exited in one go, what are the circumstances when you exited in one go?
So again, as I said, like we would try to cut down our position very quickly if we would have gone wrong in our thesis, or there is a macro regulation which has come through, which is impacting that particular company or sector. So in that perspective, we would be very quick in terms of cutting down that position. Otherwise, if we see that the company is doing well, we would continue to hold on to it. But again, as I said, like if you feel that the growth is plateauing down, or especially when the valuations have become expensive. I'll give you an example over here. Hitachi Energy is something which we bought at around 900 rupees. When actually no one was looking at capital goods. And
this was when?
So this was just during COVID, December, I would say December of 2020. At that point in time, this company was just demerged from ABB India and listed in the month of March 2020. At that point in time, if you see, the company was available at around 900 rupees. If you compare, like on a valuation perspective, it was trading at around 15 times on a 1 year forward basis. Okay. We thought, and again, there was a margin of safety wherein new share promoters were doing a buyback at around 700 odd levels. So there was a downside, I would say, of around 15 odd %, but at the same time, upside was unlimited. So there was a margin, a safety net in the form of a buyback, which was being done by the promoters as well. So we entered that name, and again, if you see in the last 1 year, the energy transition narrative became very positive and prominent. That is the time when we actually slowly started to exit that name. So as I said, like when we entered at around 900 levels, the stock was trading at around 15 times on a 1 year forward basis. We exited close to around 7,500 levels. That point in time, the valuations went to almost 120 times on a 1 year forward basis. From there on, actually, the stock has even more than doubled. But again, we have to take a call because for us, the valuations were becoming unjustifiable.
Okay, now let's extend the let's dwell more on the philosophy side. Now we're seeing all that AI generated, algo driven, fast computing. In this era, how hard is to continue to find content and opportunity like it was there in the past?
So obviously, I would say in the last, I would say 1.5 years, markets have actually also rallied up quite significantly. And again, I would say maybe 2 years back when we were getting say 10 to 12 ideas, now that would have come down to around say, I would say 6 ideas on an annual basis. But the thing with us is, Pramod, that our churn rate is quite low. So typically we just need, I would say 3 to 4 new ideas every year. And again, in 2024, we had anticipated that the market had actually become overvalued, and we exited, in fact, 6 odd names and entered, I would say, another 5 to 6 names. So, which is not unlike us, what we do in any given year. But what that has helped us to do is that if you see in the last 1 year, when the market has actually given negative returns, these stocks which we have entered, they have actually done quite well. So names like in the insurance, life insurance space, they are up almost 30% since the time we have bought them.
So you're saying that even at the peak of the market, when everything was overvalued, you could find opportunities which are undervalued, poised to grow, haven't seen grown. I mean, just repeating what all you have said, they have not seen growth in the last 5 years.
Typically, again, there is over enthusiasm or over excitement in few pockets of the market, like defense, energy transition, order book related companies. So at the same time, if you see, there is the opposite spectrum where people are not talking much about. Companies in the auto ancillary space, payments as a space, life insurance, which I talked about. So our endeavor is to slowly exit when the market becomes overcrowded and look for opportunities in the opposite direction. And which is what we have been doing consistently over the last, I would say, 2 decades.
I'm pretty sure, Vinay, this takes a lot of mental strength to continue to do it independently and away from the crowd, and mostly when everybody on the street is negative about those things wherein you are trying to build positivity and maybe stay positive also for some point in time initially. Tell me, being in the industry for so many years, I'm sure you must have received a lot of investment advices. What is the single best investment advice you've received till date? Would you like to share with our viewers?
Again, so this is something which Rishabh told me 2 years back. According to him, and very well said, research and investment is actually a thankless job. Whatever you have done, so companies which you would have picked up have done well in the past. It is there in the past. Portfolios in the last 1 year would have done well. There would be significant alpha which would have generated. Again, it is a story of the past. Maybe you feel good about it for a day or two, and then again get your head back. Just be grounded, be humble. Put your head down and start looking for new ideas, new opportunities where you need to invest on. And again, which is what I would like to say, investment is a continuous process. You can't let your guard down. You have to be at it every minute of the day. And again, that is what I would say. Be humble, be grounded, and follow your investment approach to the core, to the T.
Thank you. Thanks, Vinay. Thanks for being on the show.
Thank you so much.